Welcome to our video exploration of the implications of Silicon Valley Bank's impending closure. As one of the leading banks in innovation, it is unsettling that its doors will close by March 2021. In this video, we take a deep dive into what led up to its closure and how stakeholders across industries are responding so far. From investors both big and small to startups trying to make their mark, everyone will be impacted in some way or another by this historic decision. Join us as we unravel how the banking landscape could look like with the absence of SVB and gain expert insights on risk mitigation techniques companies can use going forward. It's not too late yet, but time is quickly running out. On Friday, March 10, 2023, the California Department of Financial Protection and Innovation shut down Silicon Valley Bank, SVB, and appointed the Federal Deposit Insurance Corporation, FDIC, as a receiver. The FDIC created the Deposit Insurance National Bank of Santa Clara, DINB, and immediately transferred all insured deposits of SVB to DINB. The FDIC announced on March 10 that insured depositors will have access to their insured amounts by Monday morning, March 13, 2023. And that uninsured depositors will be paid an advanced dividend next week and will receive a receivership certificate for their additional uninsured deposits, which is not a guarantee of full repayment. Future payments of remaining uninsured deposits will occur as the FDIC liquidates additional assets. Information about the SVB receivership. The FDIC is an independent U.S. government agency that supervises financial institutions and insures certain customer deposits. FDIC insurance covers certain deposit accounts in an amount of up to $250,000 per depositor for the aggregate of all deposits held by the depositor in each account ownership category. Uninsured deposits rank third in the right of payment behind the FDIC in respect of its administrative expenses and the payment of insured deposits, ahead of all other creditors. FDIC receiverships of insured banks are subject to a complex legal and regulatory regime under the Federal Deposit Insurance Act, FDIC. This framework is distinct from the Bankruptcy Code. Other affiliates of a bank that is in receivership may be subject to other bankruptcy or insolvency regimes, which may include the Bankruptcy Code. Deposits and depositors with a receivership bank. Sophisticated questions may arise regarding deposit accounts or other custom arrangements with, or through, a receivership. The assets in certain accounts not considered bank deposits, possibly including various sweep product and/or custody accounts, may remain partially or fully accessible during a receivership. The treatment of such accounts will depend on the specific language in the related customer agreement, which should be reviewed carefully, and the actual name of the account. Clients should consider the implications for processing payroll or other outbound banking services. Depositors with a receivership bank will face different concerns based on whether their deposits are insured or uninsured. Payment to uninsured depositors on account of a receivership certificate will depend on the liquidation of available assets, and the timing and final amounts of payment are uncertain. The resulting impact on corporate liquidity, where a company has uninsured deposits that are subject to a receivership, may flow through that company's loan and bond documentation in several ways, including the following. Immediate liquidity. To avoid any issues relating to being unable to pay debts when due and payable, borrowers should review their liquidity needs after giving effect to a receivership and consider interim bridging arrangements to solve any newly arising projected shortfalls. These arrangements may include a. New liquidity facilities and/or b. Equity contributions, after taking into account whether such arrangements were permitted under existing loan documents. Netting. Cash that may previously have been available for cash netting for financial calculations under applicable loan agreements may no longer be available. Borrowers' financial teams should review cash netting calculations, including in consultation with their accountants as necessary to determine whether certain cash should now be classified as restricted, and revise as necessary to reflect any cash that will no longer be available for these purposes. Letters of credit, bank guarantees. As an account party, if a receivership bank issued a letter of credit, or bank guarantee, for the account of a company, The such company faces the prospect of the underlying beneficiary seeking a replacement instrument. Borrowers should review their loan agreements to assess whether replacement letters of credit may be issued under such agreements. Letters of credit. As a beneficiary, if a company is a beneficiary of a letter of credit, or bank guarantee, issued by a receivership bank, draws on the such instrument may be affected. Alternative instruments should be considered.